Joining me now is John Kilduff. He's the founding partner of Again Capital and a CNBC contributor. John, kind of a trifecta here. We have those headlines from the UAE, some reports that Iraq may be willing to try to add barrels, and broader reports about Ukraine possibly looking to some compromises here. Talk to me about the implications that you see driving these crazy swings in crude that we're seeing.
Well, that $130 price point, Kelly, was factoring in the absolute siege mentality in the oil market, where we were staring down, potentially losing all Russian output, OPEC not budging, and the Ukraine situation just worsening. Now we've reversed all of that, seemingly, to a degree at least. I don't want to get ahead of myself or ourselves here. But clearly, the market took the UAE comments as OPEC blinking here in terms of not putting more oil on the market again.
So let's talk about the sequence here. A lot of people have been saying OPEC is really the only, if we lose, let's roughly say, 2-3 million barrels a day of Russian supply, OPEC could maybe supply 2 or so million of that. But as I understand it, they were waiting to see what happens with the Iran agreement first. So does this suggest they might be willing, we haven't heard from the Saudis yet, obviously, but that they might be willing to move a little bit more quickly?
Yes, the short answer is yes, but there is a catch to this UAE story, by the way. Apparently, they are insisting that the Iranian IRGC be kept as a designated terrorist organization. Right now, that is not in the nuclear deal. Matter of fact, that designation gets removed right now as part of the Iran nuclear deal. So, again, a lot of moving parts here. But again, I said this the other day to Becky Quick when I was on Squawk Box that there was about $30 of air in the price when we were factoring in and pricing in the absolute worst case scenario with potentially more to come. Again, these several elements here today changes that calculus right quick.
A reminder, if you're buying in at these levels, that there are some air pockets depending on how the Ukraine war and the supply situation plays out. The flip side of that, John, which Goldman and others keep pounding the table on, is saying that there's no spare capacity in the world, that the bullish argument for crude from here, and they've said even if OPEC steps up, they see 115 to 175 this year because the market is just so tight and was tight going into this conflict. What would you say about that?
I disagree that it's that tight. Okay, I mean, we were pressing on $90 a barrel before this crisis hit. I think that was justified to a degree, but there is more supply coming on. The Saudis themselves have 2.5 million barrels per day of spare capacity, at least. And obviously the UAE does too, so does Kuwait, the Iraqis. And we've been dealing right now with the big problem in Libya over the past several weeks here, where their oil fields have been mostly off and not on, but they could quickly come back on. So I think short of a full embargo by Russia itself on selling its oil, and by that I mean to China, which would drive China into the global market, I think that the levels that we had seen prior to the Ukraine war are sort of where we were beginning to top out at. Plus, we're going into a shoulder demand season right now, Kelly. The spring, Northern Hemisphere spring, before the summer comes, is a time when we generally see some restocking of global inventories. Refineries go into maintenance, and the pressure on the demand for oil comes off the boil for a little while. All
right, some words of caution, I should say. John, thank you so much for your time, especially on really short notice today. We appreciate it.
Shepard Smith here. Thanks for watching CNBC on YouTube.